You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to Watching the Financial Survival Network. I'm Kerry Lutz. Well, market madness has ruled the past month. Is it coming to an end, or is there more of it in store for you and I? And what does that mean for your wealth, your portfolio, your retirement, all these things and more? Well, our good friend Mark Singer is with us now, financial-planning.com. It's great to have you back on, Mark. So time to have your seatbelt buckled, huh?
Yeah, I guess so. This is better than some of the diets. Hey, listen, and it's what I tell my clients over and over again. Nothing's really changed. And what I mean by that is the markets always go through cycles. We had a 10-year period recently where we were up 16% per year on the S&P, which is way above the normal, let's call it 9% per year. So we always go through cycles. We see bear markets happen every 3.5 years. Mm-hmm. So what's changed? And what I tell my clients is, depending upon your own circumstance, we're older. So when I talked to my 57-year-old client yesterday, it really wasn't an issue. We've been here before. We've seen this movie. Markets will come back. It will go down. They've got plenty of time. But for my 80-year-old client who I spoke with yesterday as well, his circumstance is much more about perspective. And even though we've seen 26 bear markets in the last, let's call it 90 years or so, the last few that he's seen, 2008 was 14 years ago. He was a lot younger then. Now he's 90. So I think, we're all feeling the pain in terms of looking at the statement and seeing the number. But for most, it really doesn't have a true impact on their long-term lives unless they are so dependent upon income from the portfolio. Then they could be in trouble. Then, depending upon when they retire and how much they need, we may have a lot of work to do ahead. But from a big perspective, and I'm happy to talk about, what brought us to where we are and, what we should be doing about it. But from 30,000 feet, we've been here. We've seen this movie. Calm down. We'll be fine.
All right. So obviously, if you're planning on retiring in the next 6 months, this means a lot more to you than if you were looking at retiring in 6 years, right?
Well, I'm glad you brought that up because I spoke to another client this morning, and she was very disappointed with what was happening with her job. She is in her late 50s. He has just had it with his boss. He's in his late 50s as well. And they were talking about, how much income can they get from the portfolio? What's going to be the burden on the portfolio to generate the income they need? What about Social Security? When do you take it? And even though markets are down over the last, let's call it 6 months, year to date, it's not so much for those who are about to retire the value of the portfolio, but from a real planning perspective, it's how much cash flow do you need and where is it coming from? So is it coming from the portfolio? Is it coming from part-time work? Is it coming from consulting? Is it coming from Social Security? Is there an inheritance? What you really have to do is not get afraid of what the portfolio says you are valued at the moment. Go back to square one and check what your cash flow needs are, and then go back into the portfolio to see what you need to do.
All right. But obviously, inflation has a big impact on this calculus, right?
No doubt about it. I mean, listen, we've been using, historically, the planning software has been at, about 4% per year-ish, over many, many, many years. But that hasn't been the reality in the last 25 years. We've been, take a look at Social Security cost of living increases, except for last year where it was 5.9%. It was the largest increase we had in almost 40 years. So we've been living at that 2 to 2.5% level for quite some time. So this is really a shock in terms of not just where we are, but how fast we got to where we are. Which sort of brings us to trying to get a sense of why are we here where we are, right? And the markets have responded. First of all, you had COVID. And that goes back, what are we now, 3 years out?
3 years
2.5 years out?
Almost.
Seems like a lifetime, but,
really?
2019, was that what it was?
Yeah, around there, right to beginning of 2020.
Right. So we've been living with that. And that caused a shock to markets. Obviously, we were down like 37% right off the bat, but then we recovered. And then Omicron hit. And then we had other situations that were happening at the same time. In concert with the supply chain shortage, China went to a zero tolerance COVID policy. And given the amount of reliance, particularly the tech industry and the auto industry have upon products, chips, et cetera, from China, it put a real damper on the availability of products coming from China. And as you've seen, with tech, automobile prices, availability, it's been a real issue. There is a silver lining to that, though. With every crisis, there's always a silver lining. There are many corporations in numbers of different industries who are now, moving forward with understanding what they need to do for contingency plans, and they're trying to become less reliant upon China. And that, in the long run, will be good news. We had Ukraine and Russia. That certainly is a horrific event. And it unfortunately, feels like, to me, I'm no expert, that this is going to be lasting for quite some time. That seems to be what history seems to indicate. But the markets themselves were over that in terms of what they felt the impact would be. Within 4 to 6 weeks of that conflict, the market basically said, next, what's the next crisis? But there are two issues as a result of Ukraine, Russia. The biggest one, obviously, food supply, wheat, grain, et cetera, and its impact on worldwide food availability. And then some would say oil as well. And it's the oil that, when you mentioned inflation, has certainly helped to fuel the inflation. But it wasn't Ukraine and Russia that precipitated the rise. This has been coming for over 30 years now in terms of policy for energy here and abroad. And the Ukraine-Russia situation just sort of, if you will, threw a light on the fire, and it just ignited it. And we went from historic low prices of like $20 per crude to like $120 per crude in a short period of time. You had Fed interest rate issues trying to deal with inflation. And, at the highest rate we've been in many, many years, call it, 8.5%-ish, somewhere in that vicinity. And depending upon who you talk to, it may or may not have turned. But one of the things that we talked to our clients about early on this year, and it seems to have gotten lost a little bit with all the headlines, we told our clients to expect the first 6 months to be in the red. We did not understand Ukraine and Russia and inflation and all that kind of stuff. But history told us that in the second year of a presidency, with midterm elections upcoming, the markets do not do well the first 6 to 8 months of the year. And then in the third and fourth year of that presidential election, after midterm elections, they do very well. Again, nobody saw what was coming with the outside influences but the midterm election sort of laid the track that we were going to have a difficult time. So this should not be a shock and a surprise, given how well the markets had done, all the outside influences and historical precedents that were in front of us.
Right. So, so many times when markets are going higher, people say, this time's different. We're in a new economy. You go back to the roaring 20s. We're in a new era. In the 60s, it was the Nifty 50. And in the late 1990s, early 2000s, it was the dot-bomb era. But a lot of people look at the markets going down and they never say that this time is different. Maybe markets won't recover. Do you ever factor that into to the equation, Mark?
No, again, I think that the biggest thing that happens in terms of why is this time any different than last time has much more to do with your own perspective and what your needs are in terms of your own life's journey. These markets recover. Certainly no guarantees for any future performance, obviously, but the markets have a long history. And if you take a look at the underlying fundamentals of this market, markets are typically driven by earnings, and earnings are pretty good. Now, they are going to come down a bit. Margins are going to be shrunk a bit as a result of supply chain shortage, inflation, et cetera. But, these markets are still in a fairly good place. And as usual, the markets overreact. The Feds overreact. And they overreact on both the upside and the downside. There was no reason for us to go down 37% in the course of 6 weeks after COVID came out. And there was really no reason for us to have the extraordinary overreaction on the upside. We just thought we deserved that. That's okay, but it wasn't okay to go down 37%. We're in a good place. The fundamentals are pretty darn good. We're just in a tough stretch at the moment. And depending upon your circumstance, may or may not have an impact on you.
Okay. And so the market, we have some memes over time too. Real estate never goes down. Stock market never goes down. Certainly the federal deficit and the trade deficit never go down. Over time, does that have to be true? Or it could take decades for markets to come back, though. We've seen that before. After the Great Depression, took quite a while for markets to achieve their former peak and then exceed it.
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network. The information you need to thrive. Now more than ever.
Yes, but we've seen financial institutions, regulations shore up, some of the things that they've seen in terms of mistakes and errors and loopholes in the past. Go back to 2008 and the financial crises we were in. We've had tremendous regulation to hopefully, shore up some of those instances that we had seen that caused that, debacle. The real problem to me is timing. And it's timing, not in terms of investing, but timing in terms of your own retirement. And depending upon the income you're going to need from the portfolio, if you retired in 2007, you were behind the eight ball for a very long period of time in order to recover if you needed to get income when you retired. So in your planning, I would strongly recommend, if you do planning, to put in a couple of bad years, couple of red negative years for the 2 years after you are planning to retire, to try to put in some sort of margin for error, not just put in rosy numbers that are going to make the plan look good.
Right. Well, so obviously, if I could sum up what you said, Mark, it's that basically how this affects you, this market decline depends upon, I guess, your position, your time in life, your time of life. And the closer you are to retirement, the more of a factor it could be. Inflation, though, your take on it, have we seen the full brunt of it, or does it continue onward for another decade or two like it did in the 60s, 70s, and into the 80s?
I think the consensus at this point is that we're probably going to see a leveling off, at a 4%, maybe some see it as low as maybe 3.5% to 4%. Others are looking at 4.5% to 5%. I think that seems to be the range, the consensus that is out there. Certainly higher than what the Feds had said they wanted it to be, which was 2%. We're not going to see that for a while. But all of that, there's everything has a good side and a bad side. Again, getting back to the China COVID zero policy issue, that impacted supply. But the good side, the silver lining, was corporate America has figured out how to be, for many of them, less reliant. What we really have to do is learn from what's happened, take a look at what we're going through and figure out where we need to go to from here. And I will say this, Kerry, you and I have just this is the mistake I think many people make. We've just focused on the stock market right now. The headline, the real story has been the bond market. The fixed income markets have been disastrous. And this in traditional 60-40 portfolios, 60% equities, 40% bonds, if you will. This is the first time since those things were established that we have seen returns like this. The fixed income market was down 11 to 12%. And that was supposed to be your safe, conservative bucket. So for even the conservative investors who maybe had 80% of their portfolio in fixed income and were expecting to have some sort of buffer, did not. And to me, that was the real story. We've seen the stock markets do this many times before, 26 times in a bear market. But this fixed income market really got shocked by the Feds.
Right. Fixed income has really taken a hit. I mean, look at mortgage rates. Everything's connected. So these higher interest rates are going to affect real estate. Residential has been going along at 110 miles an hour. Commercial real estate, especially office buildings, not so much. So all of this liquidity being drained out of the economy going to have a profound effect.
So the real question is, we've been focusing on the gloom and doom. What's happened over oh my goodness, the last 6, 12, 18 months? Where do you go from here? And it's interesting. The University of Michigan has what they call a consumer sentiment index, and it's a marvelous number. And it's a high correlation. In other words, when the consumers believe that the markets are in a great place and they're feeling really good about it, the markets tend to do poorly. When consumer sentiment is at a low, or when Warren Buffett said, when blood is in the streets, that's when the markets get the indicator and they seem to then rebound strongly. So where are we right now? The consumer sentiment for the University of Michigan study is at all-time lows right now, which seems to be a harbinger, to looking forward, let's call it 6, 12 months out, that the market should be in a pretty good place at that point in time. Now, one of the headlines that we're hearing, is, are we headed into recession? Well, the answer is yes. At some point, you're going to be headed into recession. The question is when. More importantly, are you going to know it beforehand? And the answer is no. You typically find yourself, and the markets find themselves already into the recession, before it's actually determined that it was a recession. But the headline of the recession, which may have difficult challenges for individuals, markets tend to do pretty well in recession. So you really have to divorce your own personal pocketbook and the impact of the recession from how you're investing and how the markets react. So you have to be very careful here in terms of interpreting the headlines. I think the biggest mistake you can make right now is to overreact, either to, if you will, buy the dip, because I think there's more, downside pain to be had at this point, or just completely change it and move it to cash and go, oh no, we'll wait, for another time. I think we've felt most of the pain at this point and time. Looking forward, markets will be changing. Your portfolio construction is going to have to take into account more volatility, lower return expectations. And Kerry, you and I are both familiar with, we all know stocks and bonds, but there's also a asset category called alternatives or alts. And that is a category, if you use an advisor, you should be talking to them about looking forward. Alternatives have not done very well over the past 10 to 15 years because the markets have done very well. And alternatives are designed to do well when markets don't do well, when there's more volatility. So when you look at portfolio construction, my recommendation is to your listeners, one, talk to your advisors about incorporating it. And also in this more volatile market, you may want to look at more active management than passive management. In other words, the indexes are passive, whereas other fund managers or other types of investments will have actively buying and selling individual stocks, particularly bonds. And I think in this upcoming market, that active management may outperform the passive.
Yeah, the passive became too much of a flavor of the day, kind of, hey, we don't need analysts. Interestingly enough, the most successful analysts coming up might be AI more than human beings. The concept of using big data and factoring in all these things that a human analyst can't really begin to fathom could very well be the predominant form of active management going ahead. But that's for another day. And I would just observe the consumer sentiment index crashed, and so did one major alternative asset class, namely cryptos. Bitcoin's trading at less than a third of where it was back, well, when was that? November of last year. At that time, I had called the peak, by the way. Knew that it was peaking because of the parabolic move, but and the triple top that took place shortly before. All these things to consider. Mark, people want to find out more about you, connect with you on the web. What is the best way to do that?
Our website, which can answer a lot of the questions you might have and give you some insight in terms of what we do, is www.55retire.com. That's 55retire.com.
All right, excellent. And hey, I'd love to hear from you. How is this market decline affecting you, your plans for retirement, your family's plans, your kids' college, all of these things? You can send me an email to kl@kerrylutz.com. I'm really curious to know. And don't forget, when you're at the site, financialsurvivalnetwork.com, make sure you sign up for your free newsletter. Mark, always a pleasure, always thought-provoking and engaging. I'm sure we'll talk to you again soon.
Thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.